Well, we could talk about puts and calls. That's interesting. You know, I was an option broker on Wall Street for many years, one of the biggest producing options brokers on Wall Street in 1989 and 1990. So I know a lot about puts and calls. Do you want to talk about puts and calls?
Yeah, I think if you explain that, because it's the Beijing put. So as they describe, as Ambrose Evans Pritchard describes it, it's basically you get to play and speculate on the upside, so the price of gold may rise, but it's impossible to lose money because there's a bottom, he's saying. So it's kind of a hedge in a way?
Well, puts and calls refer to the option market, formal option market. The listed option market started trading in Chicago Options Exchange in the early 1970s based on the Black-Scholes model, or the formula, the option volatility formula, which allowed for the first time for the value of options that were out of the money, options that were had no intrinsic value, to carry a premium or a price based on this volatility formula, which was tracking volatility in the option. Now, it's very important because when people talk about derivatives, you know, this is really the beginning of what derivatives are. An option is a derivative. The value of the option is derived from the underlying, let's say, in this case, a stock. So if IBM stock trades in New York, there's an option to buy IBM stock at the current price trading in Chicago. And if the option to buy IBM stock is to buy IBM stock at $100 a share, and the price of IBM stock is in fact at $100 a share, you can say that any price that people are paying right now is called the premium. They're paying more than the actual value of the stock, and they would do this because they think that the price of IBM is going to go up. So that's the story with a call option. You have the You can call. You have the option to buy the stock at $100 a share, and if the stock goes to 120, then the value of that option goes up. If the stock goes to 90, then the value of that option would go to zero, and something like 90% of all options, in fact, expire worthless in this exact same scenario, because an option has a set period of time that it exists. 3 months, 6 months, or 9 months. Okay, that's a call. It's easier to understand what a call option is. You're buying a call option. Price of the stock's going up. It gives you a way to participate in the upside of the stock for very little money.
So to clarify, so IBM is $100, for example, and the call option is not going to. You're betting that the price is going to go to 110, but you're not buying the option for $10. You're buying it whatever the market determines it is, maybe $1 or $2 or $3 or more.
Right. So if you think IBM is going to go higher than $100 a share, you have the choice of either buying IBM for $100 a share, and thus tying up $100 per share in capital in your account, or you may choose to buy the option, which might only be trading for $1. Now, if IBM goes to 110, the value of the underlying stock goes from 100 to 110. You're making 10%. If you're buying an option for $1 and it goes to 110, the option goes from $1 to $10. So you're making 1,000% on your money versus 100% on your money. Or I'm sorry, 10% on your money, right?
Yep.
So it's 1,000 times 1,000% versus 10%. Now the risk obviously is that the option expires before IBM moves at all or moves down, in which case you put up $1 and you lose $1. So that's.
But had you bought the share instead, speculating that it would go up, you would still have the share, right?
That's right. If you own the stock and you own the shares, you own the shares. If you pay cash for those shares, you own the shares, no matter whether it goes up or down, and you collect the dividend. If you buy the option, it's an option to buy the stock at that price for a limited period of time. The risk on buying a call option outright in this way is a lot higher than buying the stock. But let's move over to puts for a second. If you buy a put, it gives you the right to sell the IBM at $100 a share. So if the stock of IBM went from 100 to 50, you could still buy it for the effective price of $100 a share. So the value of that put would go from 1 to 50. So it's a way to play the stock on the downside. A lot of people understand you can sell stock short. You're selling stock you don't own using borrowed money in the hopes that you can buy it back at a cheaper price and repay the loan of stock and keep the cash difference as a profit. That's a short sale. Buying a put means that you're buying the option to essentially sell the stock or put the stock at the current price, let's say $100 a share, or the price, the options come in different, they're calibrated according to what are called strike prices. So you might have, in IBM's case, there could be an option to put the stock or sell the stock at $100, $95, $90, $85. Those are called strike prices. So the price then, whether it's depending on the strike price and the time left in the option, that's the value of the option. That gives you the option volatility formula. That's what the Black-Scholes models is all about. That's what listed options are all about starting in the 1970s. And that's the beginning of derivatives. That's when people talk about derivatives, that's it. That's what they're talking about. It's the Black-Scholes model and the option volatility formula, except it's been extended over 30 years to be multiple layers. So essentially when you talk about derivatives today, these options where the price is derived based on the value of the underlying stock moving up and down, then people figured out that you could trade an option on an option, and then an option on an option on an option, and then ad infinitum. So that's why you end up today with $700, $800 trillion in so-called derivatives. These are just bets, layered on top of bets, layered on top of bets, and the underlying price or value upon which the whole thing is derived is buried, like the princess and the pea, if you remember that story. The pea was very minuscule, and then she was lying on 30 different mattresses. And but nevertheless, the fluctuation in that P made the princess upset. That's why a bank like Citigroup, which might have 50-to-1 leverage in the derivative markets, that means that if the equity only moves down 2%, the value of the bank goes to zero because they're leveraged 50-to-1, which is this is the problem in the Wall Street. All these banks are leveraged 30, 40, 50, 60-to-1. It only takes 1 or 2% move down, and that's the whole crisis in a nutshell, going back 2 years. And that's what we're experiencing right now, is a climb back from the crisis. It's played out in the currency markets and the gold market, and now we're on the 1 yard line, basically, after a 2-year suspense period with the inflation and the deflation camps battling it out, which is going to be right. Gold is on the ready to either break out and prove this inflationary story correct.